in your currency. Splurging millions, buying houses like Monopoly. Fucking 9 to 5, man, the money is a joke to me. Buying cryptocurrency, my money in the privacy. I make it rain down.
Hey guys and girls, welcome to this week's episode of the No BS with Birchy podcast. I'm your host, Nathan Birch, and this is the show unraveling the truth to the facade of the 21st century. We're now exiting the matrix and waking up to motherfucking reality. Thanks for tuning in this week, guys and girls. I thought I'd do something a little bit different and mash up this week's episode. And I wish I could say that I'm so great and I could do everything in my own life, but I'm only as good as those people that are around me. And behind the scenes at the podcast, we have Carolyn. She looks after the podcast, and it's been something that she's been working on for the last little while. And I thought this week, let's get her on and ask her thoughts and see, what she would like to know.
Into like suburbs, like what are some factors that you look out for to know that it's gonna be a hot spot in the future? Yeah,
good question. So a lot of people will focus on these wrong sort of things. They'll want it to be near a train line, and then someone else will be like, I don't want it to be near a train line because of riffraff, and then someone will be like, I want it in this specific city, or I want it to be a house, or I want it to be whatever. I'm just looking at it from a financial aspect. So when I'm buying a property, I want to make sure that it's got a strong cash flow, so the rent is going to cover all the expenses. I want to make sure that it's below market value, so there's upside for capital growth and there's instant equity in it. And I want to make sure that there's strong chances for capital growth on the property in the future. And how I look at that is basically most capital cities, there's some sort of areas which will be sort of undervalued, or the cheaper end that needs some sort of gentrification. So some of the properties I'll buy in like the most expensive areas of Sydney. Like I've bought in Vaucluse in Sydney, which is the most expensive suburb in Sydney. But probably 90% of the time would be in sort of mum and dad areas, family areas, a bit of the blue collar area. I grew up in Parramatta in Sydney, which is Sydney's new sort of CBD of Sydney. But there's some areas that were on the outside of that which were a little bit rough, and those areas may have had some of those old fibro shacks, and nowadays people are knocking them over, and they're very, very expensive because the infrastructure and the location of them geographically has had the infrastructure put in, and they're very sought after now. So I look for areas which are of good value, and I look for properties of good value. So when I'm buying them, if let's say for instance a unit, if there's 3 units that have sold in the same complex for 300 and I've got an opportunity to pick one up at 220,000, well then there's a good chance that my one would be worth 300,000 given that it's got all the specs. So that's where I see the value component to it. But I want the property to perform a task. So most people will look at the property and say, oh yeah, this is a good property because it's a house, or this is a good property because of this. Most of the time that's just your opinion and your emotion on why to buy the property. I want to buy the property because it's got fundamentals of helping me reach my goals financially, from a cash flow perspective, and from an equity perspective, and from a growth perspective. So I don't want to be buying stuff that's in flood areas. I don't want to be buying stuff that's, in a bad location, like that you can't change with transmission wires over the top of it or something like that. I want to be buying stuff that's fundamentally very sound with good upside for growth, whether it be from redevelopment or potentially, if it's just a unit or whatever. I want to see that there's potential there for, just for it to be cheap and for it to go up. So a lot of the properties that I do buy, I actually buy them below rebuild costs. So if it would cost say 250 grand to build a townhouse, and if I'm picking up a townhouse for 150,000, it means that you wouldn't even be able to build it for that price today. So there's a couple of different elements that I look at.
Do you look at, I guess, future developments of projects that the council might be doing, or
sometimes I look at that as a bonus. I look at that as a bonus. People will only purchase based upon that, but for me to move forward very quickly and to be fluid with building out a portfolio, I want to be wanting to hit my financial KPIs. So I want to know that if I'm buying this property, if I'm putting 50 grand deposit into the property today, I want to know that I can go back in 3 months or 6 months or 12 months and be able to pull that $50,000 equity out so I can redeploy into the next property. Because at the end of the day, my goal is to build the largest asset base that I can and then watch inflation do its thing and the price just go up naturally, yeah.
So you say often in your videos that as inflation, I guess, sort of rises, let's say hypothetically that it rises over time,
Yeah.
and that hyperinflation occurs, you say that your debt over time will decrease. How does that work?
So a lot of people here that are listening, some people might be young, some people might be older. I don't know how old everyone is, but let's say, for instance, if you're 30, 40, 50, you would have seen interest rates a lot higher than where they are. If you're younger, then you can go ask your parents and they would have seen them much higher as well. So if someone had $100,000 worth of debt today, like people are going out and buying a car with a car loan for 100 grand debt, 100 grand debt today with a 3% interest rate is $3,000 a year or $60 a week. It's not really that much to service that debt. But if you go back to the early 2000s or somewhere in the 90s or even mid 2000s, 100 grand debt at a sort of 8%, 9% interest rate would have been 8 or 9 grand a year, which would have been like 150, $200 a week to hold. 100 grand today isn't that much. 100 grand when the interest rates were higher was very much more money, but at the same time people were getting paid 40 grand a year going back 20 years ago, and the average wage is say 65 grand a year now. So the actual appearance of the cost was so much more. Basically the central banks around the world just keep printing so much more money, or currency as it's really related to, and as they print this currency, it is having less and less value. So the reason why the properties are going up is because the central banks are printing so much money. So on half my property portfolio, or most of my portfolio, because I haven't had a loan. Here's a strange thing. It's the first time I've realised this since you've asked me this. I haven't actually got a loan on a property for 5 years. I haven't bought a property with a loan. Every property I buy cash. So, yeah. With the loan aspect, if I go back and think about properties that I bought sort of 15 years ago, at the time of buying them, I bought them for like 150 grand, 200 grand. They had 100 grand, 150 grand loan on them. That debt seemed like a lot, but those properties have been inflated away. They're worth like 500 grand a piece now, and I still owe 100 grand on it. So the debt is very minimal. Like I could sell a car and then get the 100 grand and pay out a house. But at the time, the debt was much more because they're devaluing the currency and the debt's becoming worthless. Does that make sense?
Yeah. When people try to source properties themselves,
yeah.
How many properties would you say you should look at within a suburb to get like a good overview of what that current market value is? How many properties should you?
That's a hard one for me to answer.
Would it be 100 or 200 or?
If you know what you're looking for, like I can look at something and be like, this is fantastic buying. If I really looked at it, because of so many we've done recently, it could be at sort of 15,000 transactions in the last sort of 15 years. So looking at the properties that I've had to negotiate and buy, like I've become intimate with different suburbs in places I've never even been to this day. And the data that I've had to go through to understand those markets. So you need to become an expert of the market. You won't become an expert of, Sydney, Brisbane, Melbourne, Perth, Cairns, a mining town, every mining town in the country. Like there's areas that we've never even thought about. And that's the thing out there is that, as an investor, you want to become the master of that area. You want to understand what's going on in that market. You want to know what's good value. You want to know what's not good value. And looking at lots of properties, I used to spend about 8 hours a day just researching properties, for myself. And this was pre-realestate.com, pre-internet. There was no easy access to data. I had to physically go to those areas. So I focused on like a half a dozen areas when I first started, and I became experts of those areas and knowing every sale that occurred, speaking with real estate agents, getting that data and putting it myself. Now everyone has it at the click of their fingertips. So like whether it's offering on the properties or whether it's just identifying, like I've always got sort of at the moment probably about 400 or 500 offers out at any one point, and I might get, out of every 100 offers, maybe get like 5 that'll come through to fruition that will buy. But it's identifying those opportunities as well, which I've got an eye for that. So I think don't try and become a master of every area. Don't try and overanalyze it as well. Make sure that the property is going to fulfill the tasks of what you want to achieve. Make sure that the property is below market value. Make sure that the property is good value within the market. Make sure that you are not buying into a bubble. I see a lot of people that go out there to buy property and they'll be like, I want to buy a property where I've seen 10% growth for the last 10 years. It's like buying Bitcoin at 80 grand, right? Is Bitcoin good value at 80 grand? Maybe it could be, right? But it's never been 80,000 before. A year ago it was $3,000. It'd have a long way to fall down, but at 3,000, it used to be at 20,000 before that, so it was good value at that. So I like buying, I'm a contrarian investor, so I like buying things at the bottom end of the market when the markets have been decimated and against the grain. I don't want to be caught up in a bubble or in a heated market. So understand that, that the markets are not overheated and all that sort of stuff when buying.
Do you recommend first-time investors to go out to inspections and just watch how real estate agents act and stuff? Yeah,
I think it's good. I think it's good because then you can see, how they behave, how they hold themselves, their character. Get to know them, get confidence in them, see if they're bullshitting, ask why they're asking a specific question, ask them why they're being a specific way, see how they carry themselves. Yeah. Just remember that the real estate agent is a person as well, just like you and I. They have a feeling, they have, they're not as bad as what everyone thinks they are. You actually need them to be your friend as well. So they just want to get a sale at the end of the day. So there's a lot of psychology behind how a real estate agent works. They train themselves on a skill set to try and get you to pay the most amount. They want to work on your emotions, so you don't want to show any emotion when negotiating. So, do a bit of research into negotiating if you're not, I'd class out of all the things that I do, we've got a law firm here, we've got an accounting practice, we've got, finance sort of business, we've got property management, we've got a buyer's agency, we've got education, we've got tourism businesses, we've got all different stuff that we run here. But my core business, my job is in the buyer's agency, and I locate and negotiate the deals for our investors. I would class myself as a professional negotiator, so it's taken me sort of nearly 20 years to become, the weapon that you see in front of you here, right, that can negotiate things well. And it's important, to understand the basic principles of negotiating and sales, because, these people are just everyday people that want to get ahead. They're trying to do a good thing. There's a lot of bad things out there about real estate agents, and half of them are probably dickheads. But at the end of the day, they have something you want. That's the property. They want to sell it. So there's lots of things that they have that you can deliver them. Work out how you can get them to where they want to be in the easiest way. So when I'm negotiating with a real estate agent, I want to make sure that I'm being the path of least resistance for them. So I'm like, look, and it's never an ego against me or them. It's not like, I'm only going to give you this. It's like, look, I'd love to do that. However, my budget is this. If we can do it, and I don't want to offend anybody here. I don't want to, be a dick, but this is all I could afford to pay. If we can get it for this price, I'd be ready to sign a contract straight away. So then the agent knows that all they have to do is just get it for that price, and then you'll sign a contract. So you want to, ensure that you've got a good relationship with them and nurture them, because just as much as they want to sell to you, you want to sell to them your offer as being the cheapest offer as well. So, yeah.
Yeah, that's a good answer. So could you explain to me what an off-market property is and the pros and cons to that?
Yeah, cool. So what an off-market property is versus an on-market property. When you're going onto all the websites and all that sort of stuff, you will see properties listed for sale. Those properties are on the market for sale. An off-market sale would be a property that isn't listed for sale. It's not up on the internet. It's nowhere to be found. It's one that the agent may have a relationship with. The person may not want to be advertising of it. It might be that someone's got a distressed situation or something like that. When it's off-market, then it's harder to come by. So it's like, why is it off-market? Why is there a benefit? Can I get it cheaper? Do they want to have a quick sale? It's finding out those drivers and then being able to give an acceptable solution to be able to snag that bargain whilst it's off market. So yeah, a lot of properties, I'd probably say about half the properties I buy for myself and for investors are off market, and half of them would be on market. And just getting back to our last question, like about the real estate agent thing, I want to build the best relationship with the real estate agent, so then they know that, okay, when I speak to Nathan, he's going to be serious, he's going to buy a property. So if they get something that's coming up for sale, they'll sit there and go, okay, who's going to buy this? How's my day going to be the best? Like, they could take an average buyer out of the property, show the property to the person for, take them out there, show them their brother, their sister, their uncle, their auntie, etc. But then they're wasting their weekend. Or they could just sell it to Nathan Birch and he'll just go, cool, here's a contract, not even see it, don't even care. But all they have to do is get it for a very cheap price. So they might have to spend an extra 10 minutes convincing the seller to drop it down an extra $40,000. I'm getting it $40,000 cheaper, and I need to have that relationship with the agent to be able to do that, or to be able to get aware of that property as it's off market, and for the agent to think of me and want to call me and pick up the phone and say, hey Nathan, here's a property, do you want to buy it? Yeah.
So you've got to be pretty clear cut with real estate agents. You
need to be, yeah. A lot of people think agents are slimy, they're dodgy. It's like, people go, oh, the police, I hate the cops, right? It's like, well, people hate police. It's like, well, take the police out of the system and then go fend for yourself and go on. They're doing a job. They're just good everyday people. So why have the hate for anybody? So it's understanding of where they're coming from, and it's just having that relationship with them. Yeah.
So the next question I have is, how do you determine the cash flow on a property is right for you?
I guess having clarity on your goals and having clarity on what it is that you're trying to achieve is important. Once you have a clear, solid plan, then you know what you need to be buying. Do you need to be buying a property for cash flow? Do you need to be buying a property for equity? Do you need a balance of cash flow and equity? What is it that the bank requires from me, etc.? So I'm a big fan of having positive cash flow properties. They don't always have to be positive. Here's a little fun fact. Everyone thinks that Nathan's portfolio are all positive cash flow. Some of my properties are actually negative about $1,000 a week. I've bought them negative $1,000 a week. But when I bought the property negative $1,000 a week, these are mainly development sites. So they've got, a good upside for me to chop them up, build, all that sort of stuff. And like the ones that I'm referring to, they've probably, each and every one of them that I've held for maybe 5 years each, have all probably gone up maybe $2 million each. So those properties, say, cost me $50,000 a year, they've gone up by, $400,000 a year for the last, 5 years. So that's okay. But the other thing is that those properties, I had a plan to turn them from negative into neutral cash flow assets. So most of those properties now have turned to neutral cash flow, so they're not costing me that anymore. The reason why I was able to afford them, and the reason why I did buy them, is because I had so many other properties that were positive cash flow, but it was just a way of the direction of where I wanted to turn my portfolio to. In all, I want to make sure that my whole portfolio is neutral cash flow. Today, my portfolio is very, very nicely cash flow positive. Some of the properties that I've got are positive cash flow, sort of like $10,000 a week, which is pretty cool when you think about it. It's like $500,000 a year positive cash flow, and That sort of, like it just depends at what stage in your portfolio. I remember buying properties for $20,000 and $50,000 and $200,000, and they were giving me $50 a week positive cash flow, and I was so happy buying because that would pay for, food, and then that would pay for, petrol in my car and all that sort of stuff. But if it wasn't for any of those properties in my portfolio, I wouldn't be sitting here today telling you what I do, because they've all played a crucial role. Some are good for cash flow, some are good for equity, some are good for growth, etc. So those ones that were negative cash flow for a couple of years, I bought them because I wanted to become a developer and become, like, it's the next phase. So I reckon the next sort of 5 years are going to be building out the motel business and building out agriculture and farmland. That is the next thing I'm going into. But then after that, I want to come back and be a developer and develop all those large land holdings. So
Yeah, I'm pretty excited for the future.
Thank you. It's a good time to be alive. So.
It is. So moving on to renovations, what would you say is how much would you spend on renovations? What's the minimum amount or the maximum?
Oh, the cheaper the better. The cheaper the better.
Is there like a range that you should stick to?
Not specifically. However, what I always look at when doing a renovation is that I want to see a return on it. So I wouldn't just renovate the property for the sake of it. So a general rule of thumb of what I'm looking at is that I want to double the investment of what I'm putting in. So if I'm putting 10 grand into the property, I don't want to just add 10 grand worth of value or just make it look pretty for myself, because a tenant isn't going to respect it. No one cares, whatever. If I'm spending 10 grand on it, I want to make sure the property's going up like 20 grand, 30 grand, 40 grand. I want to see a significant uplift on the equity, because then I could get a return on that capital that I'm putting in. Otherwise, I could just take that 10 grand and make it a deposit for another asset. And I want to make sure that I'm getting sort of like a 25 to 50% return on my capital. So if I'm doing a 10 grand reno, I don't want to get $10 per week. If you're spending 10 grand on a reno, you're getting, $10 a week. That's, $500 a year. $500 a year is 5% return on your 10 grand. If you're spending 10 grand, you're getting, say, $50 a week. $50 a week times 52 is $2,600 over $10,000. You're getting a 26% return on investment. So sort of make sure that the reno is going to serve you well, and that you're not tying up capital that you could rather use into a new asset that's going to go up in value.
So when I first started working at B.Invested, Gemma from the IR team explained to me how equity works.
Yeah.
And I just wanted to have you explain that to the audience, because when I found out how that worked, I was like, whoa, that was some mind-blowing stuff.
Yeah, cool. I didn't know this story, so that's cool. So Gemma's awesome. She's been with us for a while now, and she probably helps out a lot of our investors with their journeys as well. But so with equity in your property, when you like, let's say, for instance, most people go out there and look at a property and they go, oh, this one's 200 or this one's 250. And quite often, like when I buy properties for investors, sometimes I always send over, let's just say, for instance, someone signs up and they want me to build a portfolio for them today. And I say, here's a property, what do you think of it? And they go, okay, that property is good. Yep. Probably half the people will be like, cool, I'll take it. Some people will be like, oh, I've gone and looked at some other properties and, this is what I found. And when I send the properties out to people, I send over a cash flow sheet so they can see how the numbers stack up. I send them an RP data so they can look at recent sales and other properties currently on the market to determine and have confidence of where the value lays. And I put in there like a blurb of like description of why, some things that are happening in the area and stuff like that, so people can make an educated decision. And I still get these people that send me something, and I had this the other day, and I had a little chuckle because I had this great conversation. It was a new investor couple. They're like, I want to do some really cool stuff. And I said, this is what we need to do. Let's go buy some properties. So they actually bought 4 properties in a day, right? They bought 4 properties in a day. And one of the properties, they questioned me and they said, I like the property and I'll take it, but why didn't you give me this property? And they sent me a link for another property. And it was a 2-bedroom property. Let's just call it a 2-bedroom property that I found was $160,000. And they found a 2-bedroom one which looked a little bit nicer, like just slightly nicer outside, but it was on for $220,000. And I turned around and I was like, that's 70 grand difference in the price, right? Why would I, go for that property? And they're like, but it looks nicer. I'm like, who cares, right? It looks nicer. And they spoke to the agent. The agent came back and said, oh, we want offers over that. And it sold already. And it's like, okay, so that one sold. It looks identical apart from a few touches on the outside of the property. You can make the garden look nicer, update a couple of things, and it would be almost the same property. Why would you pay $70,000 more? And they're like, good point, right? When I looked at it, I was like, that $70,000, that's the equity that you've got in that property that you can pull out, and that's the deposit for your next property. So when buying a home, or a unit or whatever, if everything else in the street is selling for 300, let's say 250,000, everything's selling for 250, and you pick up a property for 200,000 and it's $50,000 below everything else, that's nice, but you need to get the bank to accept that valuation. So you need to get the bank to agree to it. So let's say that you buy a property for 200 and everything else is 250. You buy the property, settle it, you go back to the bank, ask them for equity out. They give you the equity, they go and revalue the property. When they revalue the property, they say, yep, the property's worth 250 grand, we'll give you some equity. What happens from there? So you've bought the property for 200, you put down the 20% deposit, which is $40,000, and you have a loan for 160 grand. When you go and revalue it at 250, the bank will value it at 250 and give you 80% loan on that. So they will give you a loan of, say, 200 grand. The loan of 200 grand is a new loan, but your old loan is 160. That's $40,000 worth of equity that you can go and take out. With that 40 grand equity, you can use it as a deposit for the next one. So I've got, there's one lady that I was talking about, I think I mentioned of her earlier. She started with $70,000 or $80,000 at the start of last year. We bought her two properties in Queensland. One was in the Gold Coast for 200 grand, rents for $300 a week. We revalued it a day after settlement for 255 grand. The other one that we bought was in Brisbane for 150, and we revalued it for 190. So there was 40,000 in equity plus 55,000, which was $95,000 in equity that she got out within a week of settling, and then we got 80% of that 95,000, which was 76 grand. And with that 76 grand, we were able to use that for two more deposits, and we bought her two properties, one in Perth and one in somewhere else. And that one in Perth that we bought for 130, we revalued for 200 straight away. That's 70 grand, 80% of that was 56 grand, and we're able to use that as a deposit for the next one. So these properties, because they're being purchased below market value, we're able to pull out the deposit and build out those large portfolios. Either you can go to work every day, earn money, save it up, pay tax on it, and then use that after money to go and buy a property, or you could just buy a property that's well priced and below market value, rip out the equity, use that as deposit to go again and buy the next one. So it's much quicker doing it that than saving up the money.
So in regards to purchasing a property, do you recommend people to always get building and pests on their properties?
Yeah.
Is this like a must that you have to do?
Yeah, that's why I just said yeah, because it's like, would you go and buy a car and not get insurance on it? Well, it's just normal you get insurance because there's a good chance that someone could have an accident out there and you don't plan on it, but it happens. So why would you go and buy a property and then not do any checks on it? Like, it's, you want to make sure that you've got a professional looking at it. For, like, if you're spending $250,000 on an asset and you can spend $500 on making sure it's okay, spend the $500, make sure it's okay. Yeah.
Are there any hidden costs on purchasing a property that people should be aware about?
Yeah, so when buying a property, there's some standard sort of costs that are out there. You'd have your deposit that you need to put on the property, whether it be a 5, 10, 20% deposit. I always recommend a 20%. The banks like it too, and it makes it easy for you to build a large portfolio by using a bigger deposit. And from that you've got the deposit, you've got stamp duty, which depends from state to state and the price that you purchase the property for. But on average, if you were to say about a 3% purchase price, there's lots of calculators out there that will tell you, how much that would be, and you can calculate the purchase price. You've got loan fees. So generally when setting up a loan there isn't many fees, but sometimes depending on the applicant, sometimes there might be a fee to establish a loan. It might be like a risk fee, or it could be like a valuation fee or something like that to get into the property. But 9 times out of 10 there's not much fees to set up a loan, but sometimes there is. You've got your legal fees, which could be $1,000, $1,500, $2,000, $3,000, depending on the lawyer. But on average, I'd say about $2,000 in legal fees. You've got pest inspection, building inspection, and strata reports, which I'd say would be sort of $600 for a pest and building inspection, roughly, depending on where it is and all that sort of stuff. And what else do you have? If you have a buyer's agent, then there's a buyer's agency fee that would be payable, depending on how the buyer's agent works. Like and here at B.Invested, with my investors that I work with, I have a couple of different structures, but it's a flat fee that's up front, or it could be a retainer and a payment plan. So you can pay it off over 12 months, and it makes it easy to get into a property, so you can preserve your capital. And then obviously any renovations that could be needed for the property, make sure that you have enough capital for that. And when you do buy the property, generally, like if the owner of the property that's selling it to you has paid all their council levies for the year and strata rates and all that sort of stuff, there would be a balance of, you'd have to pay that back as well. So it'd be like paying the council rates, water rates, whatever, for that quarter or for the 12 months up in advance, which could account for, a couple of $100 up to a couple of $1,000 for that. So yeah.
So how much of a buffer should you set aside?
So 20% for the deposit, 5% for stamp duty, legal fees and all the associated costs, and then I'd say about $5,000 left over as a buffer, just in case there's something that's unforeseen. Yeah.
Well, thank you so much for answering those questions, Nathan.
That's all right. Thanks for asking the questions. And finally, just thank you very much for all your help you do on behalf of the community and, making these podcasts for everybody. So I appreciate all your help, and it's really, really cool. I love having you around and doing cool stuff. So it's fun. So thank you.
Yeah, no worries.
And if you do like the podcast, please just do me a favour, everyone. Sometimes, what we do is a bit demanding and all that sort of stuff. There's a lot of pressures, there's lots of things going on. We're a very, very fast-paced environment. And, my team do a lot. They really do. They do a lot of activity to try and deliver for the community, whether it be for free or for paid-for services. If you do, appreciate what we do and do appreciate what the team does, if you could maybe leave a little review on Google or Apple or Spotify or wherever you're listening this from. If you're seeing it from YouTube, smash up the like, subscribe and share it with your friends. And if you do like what we're putting out there, do leave a comment or a review, whether it be on Google or Facebook or I forget what the other ones are, product review or whatever. If you do like what my team are doing, whether it be from Zenith Legal or whether it be from Zinger Finance or One Path Accountants or Blink Property or Property Investment Agents or B.Invested or one of the other businesses, please just, give a bit of love to the team. They do awesome things. I've got a great team. I'm only as good as the people I've got around me. So please do that. And once again, if you need any help with anything, you can find us at binvested.com.au, give us a buzz, 1300 367 925, or send us an email at admin@binvested.com.au. Have a great day. Bye for now.
Like Bilal said, man, we're stuck in the matrix. This my advice, don't care if you take it. The dollar about to die, soon to be hyperinflated. This my 2 cents, don't care if you save it. Joint be decentralized and you will see you've been lied to the whole time, and it's the irony, cause they do the exact opposite. You become a slave to the system, and of your money, all they do is profit. There's no conspiracy theory, you better hear me. Crypto will set you free before the system does. I don't care if you do or you don't, but what I'm saying is the truth to the reason you choke. I never been a failure, excuse my behavior. Keep talking, haters doing me a favor. They all tell lies, I know what they been telling you. I'm the opposite, the Donald Trump of Australia. It's amazing, here for the taking, my time is never wasted. Yeah. vacant. I can't help it if I really misbehaving.